So 10 days ago, Wolf Richter of wolfstreet.com put out an article with good research talking about how last month the Federal Reserve dumped over the cap amount of toxic mortgage-backed securities, or MBS, as part of the quantitative tightening program, or QT program. And they sold $30 billion last month of mortgage-backed securities. And it also said in the article how they're planning on selling $1.5 trillion approximately left of mortgage-backed securities on their balance sheet. So one of my podcast listeners was commenting about who would even buy these things. Well, I thought about this some more, and this is why I'm doing the live stream. There's really only about a half dozen entities with enough capital and enough craziness to actually buy this garbage. So, and a lot of the players that would buy this garbage are some of the same players that either manufactured the toxic mortgage-backed securities and profited from it in the first place, and then either had to hold on to the toxic garbage and needed a bailout, or they're entities or people very, very desperate for income and are willing to take on very, very high risk. So I was researching some articles about exactly how much how much private equity firms like Blackstone. So Blackstone, if you're not familiar, is this massive private equity firm, and basically from 2009 up until like 2014, they bought just an insane amount of foreclosures all over the United States. They were buying entire neighborhoods full of houses in Nevada and Florida and elsewhere. And they were buying these things for pennies on the dollar from the large banks who didn't want to really hold foreclosures and didn't want to maintain the properties. And in a lot of cases, these private equity firms, and Blackstone at one point, according to a few of the articles I looked at, they were buying $100 million per week in foreclosures. And it appears that basically all of the foreclosure backlog that we had from the 2008 financial crisis is long, long gone. A lot of real estate investors came in, either individual private real estate investors, or then eventually you had hedge funds, large investment banks like JP Morgan, and then also private equity. And they had access to cheaper capital. They were able to either borrow from the Fed at very, very cheap rates, or they were actually even given free money to help the large banks move the stuff off their balance sheet. And Blackstone bought entire neighborhoods full of foreclosed homes, and they didn't just sit there and hold the properties hoping for the value of the properties to go up. They actually started on hiring residential property managers and renting them out. And this became so profitable, according to one of the articles, that a lot of these private equity firms, and they were buying some of these private equity firms, including Blackstone, were buying billions of dollars per year in foreclosed homes. And this became so profitable that they were making 8 to 12% per year returns. And if you're not familiar with investing, for a very large amount of capital to make 8 to 12% per year, so for a pension fund or private equity or even some hedge funds, 8 to 12% returns is, especially if you're getting rental property income off that, is pretty damn good. So they were doing this at scale. And the inventory, they were helping out the large banks and the Federal Reserve, because the Fed did not want the large banks, and the large banks did not want to be carrying all that foreclosure inventory. And now, according to my research, it's been so profitable for these private equity firms to do this that a lot of home builders have gone into building since 2013-14 just massive amounts of single-family rental homes, entire neighborhoods full of these things, because a lot of American families can't afford to buy a home anymore. So they just rent, and then the rent price goes up. So back to the toxic mortgage-backed securities, there's really only about a half dozen entities that can afford to buy tens of billions of dollars per month in mortgage-backed securities. And for every buyer, there has to be a seller. So if the Fed's going to sell, they have to buy. But that doesn't mean the Fed can't give someone artificially cheap money or free money in order for them to buy this stuff. But normally, the company has to have some type of assurance that they're getting backstopped, or they're getting artificially cheap capital. Maybe a combination of the two factors. So there, out of the half dozen or so entities that can buy, you have private equity firms, you have hedge funds who specialize in real estate or are looking for some type of annual income, like cash flow. So they're looking for just more of a cash flow. That's the goal of the fund. Rather than doing a bunch of sophisticated stock trades, they're focused more on cash flow. Or you have pension funds, and unfortunately there's a lot of pension funds here in the United States, like all over the United States and also in Europe, that are not run by financial professionals, that do not have a good financial education. And if a slick private equity salesman or slick Wall Street salesman comes and tries to sell them some of this garbage, a lot of the very high percentage of the time they will fall for it. So a lot of the same problems are going to reappear again. The other doomsday machine that Wall Street has gotten into with this credit bubble is collateralized loan obligations. So these things they're chopped up toxic garbage, but they're not the same type of chopped up toxic garbage of the mortgages that were the mortgage-backed securities, but it's the same type of principle where the derivatives machines on Wall Street at the investment banks, the PhDs, some of these guys are literally rocket scientists, chop this garbage up, and they're using VAR models, these dumb models that make a lot of really ridiculous assumptions. And this is why we get in these problems eventually. And they're assuming that they're going to get a bailout. All these large banks are assuming that they're going to get a bailout. So you have private equity, you have hedge funds, you have pension funds, you have the large investment banks. I found about 6 or 7 different articles in about half an hour of searching, and it mentioned how in that period, basically from we all know that JP Morgan and other large banks were involved in that very directly involved in a very large scale with the housing crisis of selling, subprime mortgage and other garbage, and then chopping it up and selling it to investors, promising them that it was a good credit rating, it was rubber stamped at a high credit rating, and people were buying this stuff, especially pension funds, because they were like, oh, it's a guaranteed 5% or 7% yield if you want AAA, and this is prime mortgage-backed securities, and the subprime was higher yield, but a little bit lower rating, and they relied about, the real estate market. Real estate prices never fall. The subprime won't infect the prime, blah, blah, blah. So the large U.S. banks like JP Morgan, they're involved again in the real estate market, doing things like this. And even though they got in trouble with mortgage-backed securities and the housing crisis, after the Fed started bailing out the banks and they saw that the Fed was issuing all this cheap money to private equity to go and buy up foreclosed properties, JP Morgan got their high-end net worth clients back into real estate. And they were, after they had made a lot of money before the 2008 financial crisis and then gotten a bailout, basically, then they were right back into the real estate market again for their clients, buying up the foreclosed properties. So they're making money all different kinds of ways, but they're getting backstopped to do it. So there's really, people are like, oh, you don't have any proof. There's really only about half a dozen entities that could actually afford to buy up tens of billions of toxic mortgage-backed securities per month. And that's private equity, hedge funds, you have pension funds, you have the large investment banks, and maybe you have SEC accredited investors. I think that's 5. So maybe there's one or two other entities. But pension funds, unfortunately, a lot of pension funds have a lot of capital to invest, and a lot of people who run these pension funds easily get suckered by salesmen from Wall Street in fancy suits, telling them that this is a guaranteed 7% or 6 to 8% yield or something like that, and they don't know what questions to ask, or they only see the yield and they don't see all the different risks that come along with trying to get a yield like that. But it's out of desperation and a lack of financial education. And also a lot of these pension funds, rather than hire a quality financial professional like me who actually knows what questions to ask some of these slick Wall Street salespeople and can do research, they instead of paying someone like me like $80,000 or $150,000 a year, they would rather not pay someone like that, have part-time people who don't get paid, and then just get literally raped and pillaged on fees for tens of millions of dollars per year in commissions to the Wall Street Bank. So that's my short little live stream show on who potentially is buying up toxic mortgage-backed securities. So if the Fed is indeed going to continue to sell at the $20 billion or $30 billion per month, and they're planning on dumping everything, there's only a select amount of entities that can actually afford to buy them or have that risk tolerance. And in a lot of cases, it's going to be probably dumb money at a pension fund that has a lot of capital and is desperate for a certain minimum amount of yield. And unfortunately, this is what happens at a lot of pension fund managements, and why so much money is wasted at pension funds, and why a lot of pension funds do not meet their goals. Theo says that mutual funds, 401ks are buying up mortgage-backed securities because he checked different 401ks during his research. Yeah, I mean, it's desperation out of yield. So you have these money managers, and in a 401k or retirement plan, normally you have very limited options. Well, yeah, in a 401k, you normally have very limited options. If you have an individual retirement account, you normally have more options than that. But if you're like a teacher and it's your retirement account for a state or local retirement account, or it's a 401k, you have very, very limited options. You might have maybe a dozen different mutual funds or something to choose from. So the doomsday machine is back. The other big thing is the collateralized loan obligations, and I'm not going to spend any time talking about that. You can go look those up on Zero Hedge, but Wall Street has gotten back into making these derivatives, these toxic derivatives of mass destruction, again, for CLOs, collateralized loan obligations. So out of desperation for yield, a lot of people will do this. The pension fund, the private equity firms have made many billions of dollars in the real estate market buying foreclosed properties. And it looks like all that backlog for foreclosed properties in the US, there's obviously some small case studies here and there, but in a lot of major markets, anything that's a foreclosure is not on the market for very long anymore, especially with foreign money. There's a lot of foreign money still coming into American real estate markets. Exactly, AJ. It seems nothing was learned from 2008. Exactly. Seems like nothing was learned from 2008. It's really sad. So it's just me. It's almost repeating the same mistakes probably of the last 10 to 12 years. So prior to 2008. At least homes are real. Yes, unlike mortgage-backed securities. So this answers the listener question here about who potentially is buying up the toxic mortgage-backed securities. There's really only about half a dozen entities that either have the capital or have the risk tolerance or are, let's say, dumb enough to take the risk for that type of yield. There will be some SEC accredited investors who will do it, but it's not on the large enough scale to buy that much toxic, because the Fed said in the Wolf Richter article that he quoted, and I'll attach a link to it after this video is over, that the Fed wants to dump all $1.5 trillion that they have left of these mortgage-backed securities. So we'll see what happens. I don't think it's another central bank buying them up. I think it's just investors right now desperate for yield in this financial repression, Japanification environment, especially if you're a European okay, here's just as a hypothetical. I don't specifically know of any European pension funds doing this, but if you're a European pension fund manager and you see that Christine Lagarde is specifically talking about how good negative interest rates are, and she's taking over the European Central Bank, and you see all the craziness in Europe, in European government bonds, how the yields are so low, even negative, and how European corporate bonds, the yields are either, there's junk that's negative now, and these yields are too low given the risk, and you need to make certain headline returns, you need to make 5%, 6%, 7% yield per year, you're going to start to look at these mortgage-backed securities. It's not really the smart thing to do, but if you're managing a pension fund, you cannot hold cash. Most people don't understand this, but if you're managing like a mutual fund, if you're a money manager of a mutual fund or a pension fund, you're really not allowed to hold much, if any, cash. There's normally bylaws inside the mutual fund or the pension fund that you cannot hold more than a certain amount of cash, especially for a mutual fund. I think it's at most like 10% for many mutual funds. Sometimes it's not even that. So basically, these guys are incentivized to keep their jobs, even if they lose money, as long as they lose similar amounts of money to the professional money manager next to them, they're pretty okay. They're not risking their career risk. So there's a perverse incentive for professional money managers of these pension funds and mutual funds to not take smart, calculated risks that are contrarian, even if they know they're smart, but it's smarter for them, for their career, to take less risk or take the same risks as the guy next to them. So either they don't take risks at all, or the risks they do take are the same risks as all the other money managers. Because then they can go back and say, well, I was just doing what all the other pension fund managers are doing. And this is how dumb the financial industry is now. This is the groupthink and herd mentality and confirmation bias of the mainstream financial industry, all these quote-unquote big shot money managers. RR says pension funds are in big trouble. Yep, I 100% agree. The pension funds are normally the suckers in every trade. Either private equity, hedge funds, or the large Wall Street investment banks dump lots and lots of garbage on them. No, I think the mortgages are used as collateral because I'm not sure. Actually, I'm not sure if the houses are used on collateral on the products. I'll attach a link to the Wolf Richter article. He talks about this, but I'm not sure at this point. Okay, well, that's enough for right now. We're at 16 minutes, and I don't want to spend a lot of time on this. Okay, bye for now. I am working on... Excuse me. I'm supposed to get a Daniel Lacaille interview in the next 2 hours, so I will work on getting that out later. Okay, bye for now.